If you are looking to buy shares of a company and want to understand if that company is sound and performing well, you need to read that company's annual report. Annual report is a 250 to 300 pages book that provides a comprehensive view of its performance over the year, future plans, and financial health. It's a mandatory document that every listed company must publish. But now imagine if you are handed a 300-page book full of charts, jargon, and numbers. Well, not everyone would be able to make a sense of it. Calm down. As a beginner, you don't need to go through the complete 300 pages of annual report to gauge the financial health of the company. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In this video, we are going to walk you through the important and limited sections of an annual report which you need to go through as a beginner investor while doing research on a company. For easy understanding, we have taken example of Colgate-Palmolive India's annual report for the financial year 2023-24. The first section in the annual report that you should focus on is MD or chairman's message. This is like a letter from the company's leader to its shareholders. The investor gets a perspective of how the person sitting right on the top is thinking about the business. It gives you a bird's eye view of the company's performance, including the company's vision, major achievements for the year, challenges faced, and future plans. For instance, Colgate's MD and CEO Prabha Narasimhan emphasized that sustainability initiatives such as achieving net water positivity at 3 plants and launching campaigns like the Sweet Truth to promote night brushing habits. Additionally, look for focus areas like Colgate highlighted the premiumization of their portfolio and innovation in oral care solutions like the Max Fresh toothpaste relaunch with Ultra Freeze technology. Now, these show that the company is aimed at improvising its brand awareness even further. It also aims to improve its products and is looking forward to switching to premium segment. So these can be seen as positives for the company over the long term. Next is the management discussion and analysis or MDA. Now, this is the heart of an annual report. It's like the company talking directly to you, explaining its operations, industry trends, and future plans. Industry trends help you understand how the company is positioned in the market. In fact, suppose you want to understand a specific industry, go to the annual reports of 4 to 5 companies in that industry and read this section. Once you read the industry trends in 4 to 5 companies of that industry, you will have a clear idea about how that industry is doing and who are the top competitors, what are the risks and opportunities in that industry. This section also tells you about the company's business strategy. How did their products or services perform during the year? Going ahead, are they planning to expand into new geographies or launch innovative products? In its annual report, Colgate states it relaunched products like Colgate Strong Teeth and introduced premium offerings like the Visible White Teeth Whitening Pen and how it brought new variants of some of its other products. Now, while going through the annual report, you will find mostly all positive stuff written about the company. But this one section, risks and opportunities, is where the company will discuss the kind of business challenges it may have to face and how it has prepared to deal with them. Be cautious of companies that underplay risks or don't address them clearly. A well-written MDA section shows that the management has a clear understanding of the business and its future. Moving to the next section, the number-heavy part, the financial statements. Financial statements come in 2 forms, standalone and consolidated. Standalone statements focus on only one company. Consolidated statements include parent as well as the subsidiaries. So, of course, it provides a more comprehensive view of the company's financial position. If a company has no subsidiaries, this will be stated in the annual report. For instance, Colgate mentions that it does not have any subsidiaries. So now let's look at 3 main parts in the financial statements: the profit and loss statement, the balance sheet, and the cash flow statement. The profit and loss statement explains the economics of running the business in terms of sales, expenses, and profits. Simply put, it shows how much money the company made or lost over the year. For instance, Colgate saw a growth of around 27-28% in net profit after tax in financial year 2023-24 as compared to last financial year. Colgate's EBITDA margin of 33.7%, the highest in the company's history, indicate robust financial health. Similarly, you can compare the profitability for last few years to understand how the company has earned over the years and if it has seen consistent year-on-year growth or not. Then we have the balance sheet that gives a snapshot of the company's assets and liabilities. Here you can check the status of company's debt or loans, its cash position, assets, and so on. Next is the cash flow statement, which tracks the cash inflows and outflows. It tells you where the company is generating its cash from, its operations, that is from its regular ongoing business or from investing or financing. So a company may be overall performing well, but if the company's cash flow from its business activities, that is cash flow from operations, is not healthy, that company may not be a good buy for investors. Also, Don't just read the raw numbers on the financials, but also read the notes to accounts. Remember, a lot of devil in any company's financial statements lies in the fine print, and the notes to accounts contain all the fine print of the company's annual statements. You can also look at some key ratios, which will help you compare companies and industry. But since we are making this video for beginners, it would be too much to digest if we cover the ratios in detail here. So I'll just quickly touch upon the 4 important ratios. Number 1, debt to equity ratio. How much the company relies on debt versus shareholders' money. A ratio below 2 is generally good. Colgate's low ratio of 0.04 reflects financial stability. Number 2, return on equity. How efficiently the company uses its money. The higher, the better. Number 3, return on capital. How efficiently a company generates returns using all its resources. Again, the higher, the better. Number 4, inventory turnover ratio. How quickly the company sells its inventory. A higher ratio is better, as it means the company is not sitting on unsold products and there is healthy demand. But remember, no single ratio tells the full story. Always compare them with industry standards. Moving on to the corporate governance report. Think of this as the window into how the company is run. It tells you about the board composition, committee meetings, remuneration policies, reappointment of directors after the term ends, and the composition of subcommittees. Why does this matter? Well, good governance often leads to better performance. However, too many red flags here, like frequent auditor changes or low attendance in board meetings, can be a sign to stay cautious. And well, lastly, if you do not even want to go through these many details, well, simply go through the company overview section. Now, in Colgate's annual report, this section is a 10-pager report that gives you all the crucial financial numbers. It tells you what the top management is thinking, what are they focusing on, their new launches and initiatives, and their long-term story in numbers. So hope this video will simplify reading the annual report for you to a great extent. Hope to see you soon with another insightful video.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.